Welcome to our exploration of moral hazard, a foundational concept in economics and insurance. Moral hazard suggests that having protection or insurance might lead to riskier behaviors. It's essential to understand this principle as it impacts both personal and professional decisions, influencing how insurance policies are crafted and applied. In this video, we'll explore the meaning of moral hazard, the theory behind it, and real-world examples illustrating its impact. We'll also discuss its role in major events like the 2008 financial crisis and potential solutions to mitigate moral hazard. Stay with us as we begin with its definition and significance. Moral hazard provides a lens to better understand human behavior and how it shapes the world, guiding policies and influencing everyday decisions. Let's begin our journey into this critical concept and its profound implications. In this segment, we'll dive into the theory behind the fascinating concept of moral hazard. Originating from economics and insurance, moral hazard suggests that individuals protected from risk may engage in riskier behavior. Imagine the safety net of insurance. While it offers security, it might also lead to decisions one wouldn't normally make. When consequences are minimized, behavior often shifts towards taking greater risks. Understanding these principles is crucial, as they have broad implications for the economy and personal choices. Every assurance we have, be it insurance or safety measures, carries the potential for unintended consequences. Let's see how this theory manifests in the real world, shaping our views on risk and responsibility. Let's delve into a real-world example that illustrates the moral hazard theory: health insurance. Imagine having comprehensive health coverage. Suddenly, medical bills aren't a pressing concern. This safety net might change your behavior, making you more inclined to take health risks. Our case study focuses on this scenario. When people know their medical expenses are covered, they may engage in unhealthy behaviors like smoking or skipping exercise because they're shielded from financial consequences. This demonstrates moral hazard in action. By examining actual data, we'll uncover how health insurance influences decision-making and risk-taking. Understanding these impacts helps us navigate personal health and public policy landscapes and reveals similar patterns in other insurance types, enhancing our grasp of moral hazard. Moral hazard influences individual behavior and has far-reaching effects on our economy and insurance systems. It can drive up costs and amplify risks for insurers. When people feel shielded from the full impact of their actions, it often leads to riskier decisions. For insurance companies, this means higher premiums to cover the increased likelihood of claims, creating a cycle of rising costs. The economic implications extend beyond insurance, impacting market stability and consumer behavior. Imagine the ripple effect. Businesses might face increased costs, affecting everything from goods prices to service access. Understanding moral hazard is crucial for developing sustainable economic and regulatory strategies. Next, we'll see how these dynamics played out during the 2008 financial crisis. The financial crisis of 2008 starkly reminds us of moral hazard's dangers. At its core, moral hazard involves entities taking excessive risks, believing they'll be shielded from the consequences. Leading up to the crisis, financial institutions embraced risk, assured that government bailouts would cushion any fall. Instruments like subprime mortgages, collateralized debt obligations, and credit default swaps were traded recklessly, exemplifying moral hazard. When the bubble burst, the result was a global recession, job losses, and a severe economic downturn. This case underscores the need to manage moral hazard in financial systems. Understanding the 2008 events helps us appreciate the importance of addressing moral hazard to prevent future crises. Let's delve deeper into potential solutions to mitigate such risks. Having explored the financial crisis of 2008 as a stark example of moral hazard, it's now time to consider solutions. Addressing moral hazard requires regulatory measures and incentive structures. Regulations can limit risky behavior by ensuring accountability. Incentive structures align actions with desired outcomes by rewarding prudent behavior and penalizing recklessness. Together, these solutions reduce moral hazard, creating a more stable system. Let's dive into real-world examples, illustrating how these solutions function in practice, aiming to create a balanced approach that provides necessary protection without encouraging undue risk. Let's explore how moral hazard manifests in auto insurance. Imagine you have comprehensive coverage. How might your driving behavior change? Drivers with full coverage often feel shielded from financial repercussions of accidents, leading some to take greater risks. To illustrate, we'll examine a case study showing increased claims frequency among extensively covered drivers. This suggests that comprehensive insurance can unintentionally encourage riskier driving habits. By analyzing real world data, we uncover the relationship between coverage levels and the behavior they foster. Through this case study, the impact of moral hazard in auto insurance becomes clear. Next, we'll examine ways to balance protection and risk, aiming to mitigate moral hazard's adverse effects. As we close our exploration of moral hazard, we must consider balancing protection and minimizing risky behavior. Policymakers face this challenge when designing insurance policies. Too much protection can encourage risky actions, while too little can leave individuals and businesses vulnerable. The key lies in finding the right balance. By designing policies with sensible risk management and incentivizing responsible behavior, we can mitigate moral hazard's adverse effects. Strategies may include tiered premiums based on risk, regulating high-risk activities, and incorporating co-payments to ensure shared responsibility. Effective solutions provide necessary protection without fostering undue risk. In our next segment, we'll distill lessons learned, guiding policy and personal decision-making. In conclusion, moral hazard is a critical concept in economics and insurance. We've seen how insulation from risk can lead to riskier actions, from health insurance promoting unhealthy behaviors to financial institutions taking excessive risks. These examples highlight moral hazard's significant implications for individuals and the broader economy. We've also delved into solutions like regulatory measures and incentive structures designed to mitigate moral hazard. Understanding these examples helps us grasp the significant implications for policy and personal decisions. Comprehending moral hazard aids in crafting better policies and making more informed decisions. Striving for a balanced economic landscape. Recognizing its nuances helps navigate and shape the economic policies affecting us all. Continue exploring the world of economics and stay curious. If you found this video helpful, don't forget to subscribe to our channel and share it with others who might benefit. Understanding concepts like moral hazard impacts how we view economics, risk, and human behavior. By subscribing, you'll access more insightful content on these principles and their world-shaping effects. Share this knowledge to foster informed discussions and strong learning communities. The journey of learning never stops. There's always more to uncover and understand. Stay curious, stay informed, and help build a world where we make better decisions. Subscribe now and continue exploring the fascinating world of economics with us. As we sign off, keep questioning and learning.